school in São Paulo, Brazil. And we're here now to present you the current situation Pan American is facing and also discuss our analysis and our recommendations about it. So here, we're going to start with a company and market context. So what we see about the company and market context that the company is facing right now. So we can see a context of volatility of the silver prices. That's something the company has been facing on the last years, and that's something the company was not highly prepared because it isn't like really leveraged, and the silver is the main product the company deals with. The second problem it is facing right now it is the low leverage capital structure. The company has a big cash structure, but it doesn't have much debt, so it isn't well leveraged. And the third one is the dividend policy that, as we could see through our analysis, differs a lot from the other competitors' policies. So what are the implications of this context I just presented you? So the first one is the return on equity and the return on assets of the company is a bit inferior than the competitors. The second one is a higher beta than the competitors. And the second one is the WACC of the company could be optimized through debit, as we're going to discuss next. Now I'm going to call Danilo to show you our problems and recommendations.
Thank you very much, Barbara. So good afternoon, everyone. So as Barbara said, now we're here to present you our solutions and recommendations for the main challenge that we believe that Pan American is facing, which is to develop a plan of actions that will support the company to successfully finance its portfolio, right, its plan of action to growth. So in order to do that, we divided our plan in four main pillars, which is the first one is to restructure the company capital, right? So capital restructure. The second is the project financing. So here we're going to say how the company can best, what are the best alternatives for the company to finance its two main projects in the new mines that they bought. The third one is how can the company handle the volatility, uncertainty in prices of silver. And this is a really important thing that, as Barbara mentioned, has implications on company performance. And the last but not the least is how can the company reevaluate its dividend policy that also impacts its financial decisions and how the shareholders respond to the company and how they evaluate the company price.
Okay, so the company today has almost no debt, especially if compared to the level of cash it is sitting on. So compared to the competitors who has a cost of debt of around 8 or 9%, the company could, if leveraging the company could reduce its WACC or weighted average cost of capital by around 8 bips in our estimations. So we did an estimation on how much could we leverage the company. So the company has 287 million capex to do in 2005, around something around 300 million of capex, joining new projects and old the maintenance capex, and it has a cash position of 230 million in cash. So it could distribute this cash with a buyback of 43 million buyback in 2015, and then looking forward, the company should try to attain the 40% debt to assets leverage that other competitors have. So this would be translated in around 800 million debt level in around 5 years. So the company would get 150 million per year of debt to finance its capex. So we did this estimation based on our capex projections, and therefore, that's it actually. So the company should have in 5 years around 800 million debt. And so the new projects, how could we finance them? We should finance the new projects with debt as well. So the Pan American Silver's cost of capital is higher than the cost of debt as we've seen it, and both projects have a discount rate quite low of 10 and 8%. This just project being financed by a debt with a cost of 8.17% that we've seen before. We could have gains in both sides. So we'll have less cost financing capital, and on the other side, we will have a tax shield of around 15 million or 16 million, which would accrue in 60% the value, net present value of these projects. So talking about La Colorada and Dolores projects.
Right, thank you, Rafa. So the third point is that how can a company handle with the price volatility concerning to its silver stocks, right, from the revenue that comes from silver? The two main, what is the situation here? First, as Barbara mentioned, the volatility in silver price has been increasing a lot during the last years, right? And what is the situation for the company? Pan American is directly exposed to these variations, right? So the company, as mentioned in the lecture, the company don't do any type of hedge or don't use any financial instrument to be protected from this price volatility. So what complications are brought to in this situation? First, the company's, as we could analyze compared to other competitors, the company's beta is higher than the other competitors. Or they are more, they have a larger portfolio with other types of mining, right? So they are not as concentrated in only one metal as Pan American. And as a consequence of that, the investors for sure will require a higher rate of return regarding to this higher beta rate. The second point is that this price volatility is not exactly a risk that is embedded to the Pan American's operations, right? So the core business of the company is to run its operations to be really to cut costs, to be efficient, but the company itself cannot do many things concerning to the prices, right? The company is a price taker as the main product is a commodity. So what could the company do? The investors themselves, they're not interested directly in the volatility, in the risk associated to the silver volatility. They are interested in the risk concerning to the Pan American operations efficiency, right, to the operations in Pan America. And if they are interested in the volatility in silver prices, they have better financial instruments to invest on that, which are the ETFs and the commodity itself and other financial derivatives and other markets that they could speculate with the silver volatility. So what kind of solution would bring here? The Pan American company, what it could do? The company could use the silver future contracts in order to hedge its positions and decrease the variance on the company's revenues, right? Once the silver is the main product, it accounts for around 60% of revenues. The company could reduce its exposition to the variance of price by doing the silver future contracts.
So now, evaluating the dividend policy, as I already said before, the company has a dividend policy that differs from its competitors. So why do we think we should evaluate the dividend policy? First, because the company gives higher dividends than its main competitors. And second, because although the company has, as I said before, a lot of cash right now, we're talking about new projects and investments. So we have to consider it when we're talking about the dividend. So here we brought some differences between the dividends of our company and the other companies, the main competitors, especially according to time and to the most recent value they had. And we have the information that Pan America's dividend has grown 71% over the last year, while the average industry growth is around 4%. So what we did here is that we calculated the operational cash flow, and we subtracted the debt, and we got to the money that would be available to be distributed. But we got this money and we divided it through like 5 years. That would be the time we would have to pay the new investments. And this money we divided by the equity value, and we got to a 7.16% dividend yield.
All right. So just to do a quick recap of our main recommendations here. So the first one is to conduct the capital restructuring. Why is it important? It is important now because the company is not as leveraged as it could be once it is in a business that is really capital intensive. And what could be the benefits of that? As Rafael mentioned, the company could benefit from the tax shields and decrease, and also from a source of financing which is cheaper than on equity. The second thing is the project financing, right? So our recommendations here are related to the new capital restructuring. So we would issue debt in order to finance these two new projects that the company has. And by doing that, we can capture those benefits of having a more leveraged company. The third one is that the company has also the opportunity to decrease its exposition to the silver prices variation. And by doing that, the company can decrease its beta, and they can focus even more on its core business, and they can over-deliver the returns to its shareholders. And the fourth is to reevaluate the dividend policy, as Barbara mentioned, to have a policy more in line with the market, and to conduct this share buying in order to finance, or to make it feasible, the capital restructuring. So concerning to these main 4 recommendations, of course, as you might be thinking, we have risks associated to that, right? So on the first one of the main risks that we identified is that difficulties in raising the volume desired in capital markets on a favorable conditions, right? So as we mentioned, we have a large amount of debt to be issued, right, or money to be captured as debt. And in this moment, exactly, can be really challenging to capture this money in a favorable condition. The second one could be negative shareholders' reactions on the shares buyback. If we don't communicate clearly, and if we cannot send them the message of this capital restructuring, if we cannot convince them that this is a good action for the company. So the main risk that we could identify for the project financing is the finance distress, the company financial distress itself, because now the company finances all the risk of its projects based on their assets and their cash, but we would add another liability to the company, which will be the debt. The third one, the main risks are, of course, the cost of carrying the future contracts, the silver future contracts, and in case the prices, the company wouldn't benefit if the silver prices went up, as it would benefit on its position today, right? But as we discussed in our bill, this is not the main core risk that the company should incorporate. Its main risk should be concerning to its operation. And the fourth, the main risk that we identified here is also the negative shareholders' reaction, especially concerning to share price depreciation.
To finish our presentation, we put together a few key metrics that we would like to show how they would change depending on the action. If we can see, depending on how we use our hedge, we have great position in cash. We can value in revenues between 900 and 1.3 billion, and that's 30% variation that we can be exposed. As Danilo said before, investors will not be willing to take that risk, because if they wouldn't buy shares. They would buy silver itself and will be exposed to that risk. In our operating cash flow, we had an increase based on our reducing cost from the projects. So our operating cash flow increases a little bit year by year, depending on the outcome from the new projects and the new mines. Our total debt, on the other hand, is going to increase a lot. This increasing in total debt, that's going to reduce our WACC and get us close to the competition. We actually believe that all these actions get us for a more solid financial position. With this financial position, we can send a clear message to investors that we are on the right track. The market has its oscillations, but we are working to get the best result possible. Thank you very much. We're now open for questions.
I have a couple questions, but I'll start with one on the silver futures market. So you said that one way is mitigate the risk of the volatility is to enter the futures market. So can you give me a little bit more details on what exactly you would do? Would it be as straightforward, or would you do derivatives? A little bit more detail on that. And then the second question is, Pan American, as we heard from today's presentation, has never hedged silver, so this would be a massive change. How would you communicate this to the shareholders, given the fact that it's something the company has never done before? And what do you expect the shareholder reaction would be to putting that in place?
So to concern to your first question, right? When we came up with the solution, we got the example of other which happens the same in other commodity markets. For instance, if you are a farmer, you can have part of your soybean production, and you can sell. You can already pre-sell. You can lock the price of this crop in the future, right, through these kind of contracts and future contracts. And you produce it, and you already know how much. You already know the price that you're selling them. So you, the producer, you're not taking this kind of fluctuation risk because it's not part of your operation, right? As you said in the lecture, in this kind of markets, the commodities, the companies, they are price takers. So this specific risk is not exactly embedded to the company. What the company can do and what the company can act on is on its operations, becoming more efficient, cutting costs, and investing in new technologies. So this type of risk is the risk that the company should own itself. So connecting to the second question, we would suggest doing it phased, right? Of course, not once all the production at once. The company could do, I don't know, maybe the first 20% of the production, 30, until it reached 50%, which was our recommendation here, right? So like less 50% of the production, and still get a bit of the risk of the price fluctuation. By doing that, phasely, the company could feel what would be the shareholders' reaction. Our best guess, with all the information that we have from the cases and of the theory that we have on finance, is that the investors, they are, generally speaking, they are more interested on the company risk itself. So if they will be more concerned, if they want to speculate exactly on silver prices, they already have better instruments to do that, which will be, they by themselves, they could operate this kind of future markets. They don't need to have the silver itself. They could build positions and speculate on the silver prices. By doing that, we expect not only the beta of the company to reduce, but also the results also to increase, right? Because you have less risk and you can focus on only on your operating risk.
Just a follow-up question. You mentioned during your presentation the beta, and then you mentioned it again, the beta. Why would the company want to reduce its beta? As far as I understand, the beta is the proportion of how the stock performs versus the market. So a beta over 1 means that if the market goes up, or a beta, let's say, on 1.1, means that if the market goes up 1, the share price goes up by 1.1.
Yes, exactly. It's a measure of volatility, right?
Yes.
So what we're saying is that we don't want the company only reduce the beta itself just by reducing it. We're just saying that part of the volatility embedded on this beta is related to the great volatility in the silver prices, right? Because the silver is 60% of total revenues, and this revenues, this price has been really volatile during the past times. So if you compare to other competitors that have a less concentrated portfolio of metals, they are less exposed to this variation that comes from only one main product on your portfolio. So by doing that, the company could decrease or be less concentrated in one risk that is not under control of the company itself.
Question, you mentioned on one of your slides, you suggest having a policy to issue $150 million of debt every year. So as you know, we're experiencing low interest rates, that's the environment. And there's some concerns that the interest rates may go up in the future, and that would certainly affect your dividend pay. So have you done a scenario in terms of what would be the threshold that you would suggest that you would recommend still having that policy in place?
So we didn't run different scenarios for changes in the interest rates. The idea here of issuing 150 million debt every year is to attain a level of around 40% in capital structure of debt to equity. So the idea here is, on one side, you would gain value with the tax shield from the debt, even if the interest rates went up. And on the other side, you could leverage in the company that actually has a really high capex every year and has capital needs for long-term investments, could reduce the need of investors' capital, which would reduce your cost of capital actually. As long as the company is not in distress, of course, as long as it's controlled, you would reduce the cost of capital, raising the share value. But we didn't run any analysis on different interest rates going up.
Follow-up question on that. Are you recommending to issue debt and then buy back shares? Is that
No. What the sequence would be, first the company buys back 40 million shares this year because it has excess 40 million cash in excess for the capex it need for this year, for 2015. Then the next year it will need around 200 or 300 million cash for capex again. This capex will be done with new debt, so it will raise some debt to do this capex, and it will do this every year. It will raise 150 million debt every year until it reaches around 40% in debt.